welcome to the Diwali special of Money, Money, Money. Our conversation continues. Last week, our experts told you all about equity investments. Now we're going to talk about everything beyond equity. What are the other asset classes you can look at as you aim to maximize your wealth this year, Samvat 2073? Let me quickly reintroduce my panel of experts. Of course, Ashish Shankar of Motilal Oswal is continuing to be with us as well. And market veteran Nilesh Shah of Kotak Mahindra Asset Management Company. We also have Gaurav Mashruwala giving us the financial planning and that expertise, that particular perspective. And of course, Pratik Pant of Sanctum is still with us as well. So let me start with you, Ashish. Beyond equity, where else can money be made this year?
So let me start with fixed income. I think the last 3 years have been fantastic for fixed income investors as well. And we've seen interest rates being cut by almost 150 basis points. We've seen some of the funds which carry duration give double-digit returns. Even tax-free bonds, someone who had invested at 8.5% today is sitting on a nice capital gains. So it's been a good time for fixed income investors. However, going forward, I do believe that a large part of the gains has been captured. So within fixed income, I think it's a good idea right now to lock in yields either through FMPs or through funds which do a little bit of credit, apart from AAA, AA, single A. If you give it to good quality managers, you'll still be able to get a 7.5 to 8% return. So I think in fixed income, it's the time now to keep it simple, lock in yields and stay put for the next 3 years. A large part of the exciting part of the journey is over. We do believe that we are probably at the bottom of the interest rate cycle. Although, given the recent inflation number and the commentary from the Monetary Policy Committee, we may see one more rate cut. But the fall in yields may not be as much as we've seen over the last year or over the last 3 years.
Okay, so Ashish has obviously touched upon a really important asset class. And Nilesh, that's the question. Debt obviously has a significant place in the portfolio as well, right? So looking at the current environment, what's the right equity and debt mix that you think a typical retail investor should keep in mind? And then how to maximize the debt investment? Because as he mentioned, now this is no longer the time when you can, lock your money in an 8% plus FD, because those days are over.
So typically it's individual's risk profile which determines how much he should put in risk assets like equity and lesser risk assets like fixed income. But the thumb rule is that 100 minus your age is your allocation towards risk assets, and your age is your allocation towards non-risk assets. Now within fixed income, you could have government securities fund which are far less risky, and you could have credit accrual funds which invest into higher yield papers by taking credit risk. My recommendation this year will be to focus on credit accrual funds. They have a fair amount of spread over government securities fund, and as the pace of interest rate on the way down starts slowing down, the coupon income will become more critical, and hence credit accrual fund should outperform duration fund in next year. So focus on credit accrual funds.
But what about the risks associated? Because in the last 1 year, we did have 1 or 2 instances where there was a bit of a concern with some of these funds that were investing in a certain type of corporate paper, and some concerns came in. Because here one should remember that unlike an FD, here your principal is not necessarily always protected, right?
Agreed. See, most people focus on principal protection rather than return generation. Now, there was a time when FDs were giving 16, 17, 18% return. Then a time came when they were giving 9, 10 and 11%. Who knows, a time will come from current 7, 7 and 8% level to 3, 4, 5%. Your reinvestment risk on FD is far more than your principal risk on FD. The second thing is also this perceived notion that fixed deposits are safe. As per law, the DICGC cover is available only up to a certain limit of, let's say, 100,000 rupees. Beyond that, it's a credit risk on the bank. And all of us are banking upon the implicit faith behind this banking system, which so far government has ensured that no matter what losses a bank make, the depositors don't suffer. So my recommendation is that don't just look at the principal protection, look at the overall return generation. Despite 1 or 2 mishaps which happened in some of the credit accrual funds, on a 3-year basis, on a 2-year basis, they have delivered fantastic return. Of course, on that particular day, it gives a crazy negative return, but you are here for 3 years, you are not here for 1 day. And on a diversified portfolio, I still think credit accrual funds will do better than the duration funds.
And typically, what is the sort of additional spread that one can expect when one is investing in these credit accrual?
As of today, the coupon spread between government securities fund and credit accrual fund is ranging between 200 to 250 basis points. That's a fantastic number.
So you can, of course, hopefully have
It's
much
probably
better
one of the,
returns. Yeah.
You know, in the top quartile of spread over last 5 years.
So that's the way to have sizable returns, hopefully in your debt portfolio as well. Gaurav, your thoughts? What's the approach to debt for you now?
So for me, it's more based on when would you require money as a planner. When are you going to have that cash outflow for whatever dreams, aspirations, responsibilities that you have? If you're likely to require money in next 3 to 6 months, stay in liquid fund or ultra short bond fund. If it's little longer, say 2.5 years, it could be debt funds. Maybe debt funds which are not kind of trading too much on the interest rate risk. Longer time, you may want to look at equity. So within debt instruments, you will also have to kind of diversification, because there is something which is needed immediately, somewhere you have time. Based on that, construct your portfolio. You can't get in a situation where you need money after 10 days and you are put into a debt fund where there is interest rate risk. So take a call based on your requirement.
Okay, Pratik, you mentioned for a lot of your clients, preserving wealth is more important than maybe maximizing returns. So in that context, given the fact that interest rates are heading down, we might have, as he mentioned, Ashish mentioned, another rate cut. How is your approach to debt right now?
Right. So I guess it's a mixture of different instruments which are available in the market. So, I would tend to agree with what Gaurav said. If you're driven primarily by liquidity considerations, you would have to put money into ultra short bond funds or liquid funds, which actually allow you the next 6 months to a year without impacting, a lot of entry and exit costs which are there. Because it's also important to look at, are there any loads in any of these funds when you're trying to exit, and what are the tax implications in these fund categories? Some of the newer...
So from those parameters, then what sort of a fund would you then recommend?
So as I said, if your duration, if your exposure is less than a year, you would tend to put money into ultra short bond funds which are there right now. There are some of the perpetual bonds which are also available in the secondary market, and some good corporates which have issued perpetual bonds tend to become an interesting option. In the past, a lot of our investors have invested into tax-free bonds and have reaped, a fair bit of rewards because of the interest rate cycle over the last year or so. So options are limited, really, right? When we start looking at slightly longer term maturity is when we then go into medium term bonds or credit opportunity bonds, which Nilesh was talking about. One of the new categories which has emerged of late has been the AT1 bonds, or the or really the public sector bonds, which are additional tie-up bonds, which does tend to offer you about 100 to 200 basis point additional spread. Again, you have to be very careful about the type of instrument and who is advising you on that. We've had we've had these additional tie-up bonds offering from 14% coupon to 10% coupon, and how do you really take exposure into the right public sector? Because they do tend to be quasi debt type of instruments which have more preference equity type of tax treatment. So these are some of the instruments where you would take exposure when you're looking at this.
Okay, so those are the options you can keep in mind when you're thinking of debt over the next 12 months. We'll take a break. What about other asset classes? What about gold? What about real estate? That conversation on the other side.